Very good morning, everyone. Welcome to Admiral Markets. My name is Chris, and we're going to take a look at the live trading room webinar here on this 6th of January, 2015, our first webinar in the new year. Before we actually take a look, though, at the charts and see if there are any interesting setups, though, first this PowerPoint quickly here, explaining the fact that the webinar is intended for a global audience. It may not be suitable for everyone. To find out if it is, please visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Also, please be aware of the fact that trading for exchange is considered high risk and it may not be suitable for all investors and traders. Therefore, please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for educational and informational purposes only. And by continuing watching this webinar, you agree with the disclaimer. Alrighty. Thank you for your attention. So today's focus is going to be on, let's see, Fibonacci and wave analysis. In fact, so we'll be using fibs and the waves to make a better judgment of good setups, high profitability setups, or probable setups, identifying areas of confluence that provide an edge, provide a high probability profitability or long-term edge, basically, right? So we'll be using, of course, other tools as well. By the way, as you most likely know, I tend to use trend lines, moving averages, and Camarilla the most of all. But today will be the most focus on fibs and waves. Now, unfortunately, the wave analysis I made for, no, it is available, sorry, I just didn't refresh it. So with that said, let me take a look now at the calendar first of all, quickly. We have pound services in our London session here, 1 hour 43 minutes, and PMI on the dollar as well. Alrighty. Well, nothing spectacular. Will be interesting to see what the PMI numbers are. I think they'll have their usual smaller effects, maybe even bigger effects. Let's see. Will be interesting to see what the numbers are. Let's take a look at the whole week and see if there are any big events that we should be aware of. Wednesday we have ADP. And Friday, indeed, we have the non-farm payrolls, NFP, and unemployment rate. So that, of course, as always, will be interesting to see what the 2015 will hold. Basically, the euro-dollar, as you probably have noticed, has been falling like a stone, like the pound-dollar as well. The dollar-yen hasn't been rising as much. If we look at the yearly charts, what we can do, of course, and take a look at basically 2014 as a trading year, we can see interesting information. Let's take a look at the charts right now. When we look at the yearly candle, basically, I think it provides interesting information. In most cases, it does. I think there's a pretty good probability, 75–80% chance that the yearly candle gives a pretty good indication of what part of the next year could happen. Part of that indication basically is the fact that if you look at the euro-dollar yearly candle, it just had a tremendous bearish candle, and basically if you look at the level where it started, it was 135. It had a high of about just nearly at 140, just below that in fact, 139.93, and then it closed 2 or 3 pips, 4 pips max off of the low. So what kind of information can we read from that? First of all, there are 3 things I think that are important when looking at that. First of all is the fact, how big is the candle? The low, the high, basically minus the low. How big is the candle itself? Because if the candle is relatively small for a year, basically that could mean indecision. Well, the euro-dollar candle was about 1,900 pips, so that's good. For a yearly candle, that's good. Right? Anything, of course, it's currency pair specific. The euro-pound would not have typically that big of a range. It typically would be a few hundred pips, right? But for the euro-dollar, we would think that anything above, normally speaking, anything above 1,500, close to 2,000, should be okay. 2013 right, was an 1100 pip candle. I'm talking about this area. That already showed how small that candle was. All right. Point two that's interesting to look at is basically the wicks on both sides of the candle. Wicks. In this case, we had 25% wick on top, but no wick at the bottom, except a couple of pips, which in percentage terms is nothing. It's 0.1%. So it's we can just ignore it. It's just closed right at the low. Point three, which is important, is the close. How close is the low? How close is the close, or how near is the close towards versus the high or low? So when we look at these three things, we can make a judgment on each of these currency pairs by using the entire year to our advantage to estimate what could be likely throughout this year. If you do that exercise year in, year out, you'll see that that has pretty good value. So the high minus the low in the euro-dollar sense is good. There's nothing extra unusual about it. That's fine. It shows normal strength. Wicks, well, no wick at the bottom, just a normal wick at the top. So that shows basically a good big bearish candle. And the close was near the low. That means, again, a big bearish candle. So what we have, if we look at the euro-dollar yearly candle, is something like this. Very, very, very bearish. And as we can see, the January month already just started, and we already had basically, when looking at the month itself, we started off here at 121, and we already had more than 200 pip fall throughout this month. So I said in the webinar that there was a 90 to 95% chance of last year's low being broken. That has already occurred. The only thing is I thought it would happen later. To be honest, to be very precise, I thought it would happen in February or March. It happened already the first day of January. So yes, it's true that the low got broken. I was a bit off on the timing though, but okay. A bit caught by surprise how fast the fall continued throughout the holidays, to be honest. But that sometimes happens. The yen also continued quite strongly through the holidays. This can happen sometimes. So the euro dollar finding a lot of downside pressure here, and looking at the yearly candle, that itself is not a surprise at all. A very big candle. If you look at all the euro dollar movements, it's very precise. I mean, it's pretty precise, I think, how you can interpret the yearly candle and what kind of effect it had for part of the next year. This is a very bearish candle. So all in all, when looking at that bearish candle, it should continue lower. 115, 113 are natural targets for this euro dollar in the long term. Perhaps even parity. Why? Because if we put a fib from here to here, those are the targets, 113 and parity. All right, so anyhow, this is what we can do basically for pair to pair. Look at the yearly candles. I don't know if that really, we'll probably not do it for everything. I don't want to make it too repetitive here. But those are the three things I look for in yearly candles. If you have a specific pair in mind, let me know. We can do this exercise together one more time. Otherwise, I guess it's fairly simple, I think. So I will just leave it, I think, up to you to do this on the pairs you find interesting. But I thought it was worth it to do at least on a couple pairs, because considering the fact that this is our first trading webinar since, let's see, when was our last one? Wednesday, right? Yeah, so this is the first one in the new year. So, of course, Wednesday we had an idea that the euro dollar would end up very bearish, but now we have the confirmation, the real final definite confirmation. So this is really the first webinar in the new year, I see, indeed. Alrighty. Yeah, great, Katie, indeed. I think so too. I think it gives a nice idea, you know, if there is sometimes it just shows indecision, like the pound CAD, for instance, is a good example. just shows kind of an indecision, or we think which one. There was the gold, for instance. Actually, it's a great year. Sorry, not a great year. It's a great example of a year and a pair that is showing indecisiveness. So we can take a look at gold as well and look at this analysis. Before we do that, though, just quickly the wave analysis, because it is a wave webinar, a Fib webinar. So looking at the Fib on the monthly chart, you can already quickly see where the targets are, right? That's one way of doing it. Of course, we can use Fibs on lower time frames. We can do that in a second. From a bigger point of view, most of you already know it, though, but just in case, this is basically oscillating up and down, so it's kind of a correction. So we could expect correction to continue, and then maybe correct like this again. For the moment, that's what we could expect. So if you look at this particular part, most of you know it already, but this is probably the most likely variant at the moment. This is let's see, this is an A, and then we have a triangle for A, B, C, D, E, like this. E completes B. The B is basically a triangle with A, B, C, D, E in it. After A, which was impulsive, as you can see, fast move down, then the triangle, we should expect, again, a fast move down for C. That was the analysis done beforehand for quite a while, and we can be happy that indeed this is happening because it's confirming what we were saying here in this trading room. So that's good. And why is it confirming? Because look at the speed that price is moving down now. Yes, it is. In that way, it's confirming. So far, it's behaving as we would have expected with the E finishing like this. Boom, fast down. So it seems to be true. I mean, it's never 100% guarantee, but that is the basic mode at the moment. Let me quickly show you what the wave analysis here is saying with regard to the euro dollar. When you look at the euro dollar 4-hour chart, you see that we had a very lengthy wave 4, W green, WX green, W green, X green, Y green, like this. To complete the blue wave 4, here's the blue 3, here's the blue 4, and then now we've been in the blue 5. That blue 5 surprised me because I was expecting actually a bigger consolidation. As I already told you in my forecast of 2015, I expected January, February, perhaps even February to be consolidation. Well, that hasn't happened. So I expected the holidays to be used kind of as a start of a consolidation, which ultimately didn't happen. I still think it was a good assumption. It just didn't happen. Those things can happen, right? You never know. But now that we see the trend continuation here, this was a key level right in here. And when we broke that, I already was afraid that basically this particular consolidation, let's say consolidation idea would not occur. Right? Here was about the validation level. So then we broke, and it broke pretty fast. Now we're looking for, when we zoom into the hourly chart, we're looking for, basically here we see a 1, 2, 3, 4. We're in a 5. Well, it could be extended, but this could be a 1, 2, 3, 4, 5. But with so much downside bearish pressure, I'm going to be changing the wave count. It's going to be extended in some way. I'm just not sure how. So it doesn't make sense to anticipate that as yet because I'm not sure how that will develop. But for the moment, though, there's certainly one more downside happening here And there'll be more probably, but in due time, we will adjust it for that. You might wonder why not adjust it now, but as I said, it doesn't provide enough information to have a clue what that could be. So I don't think it makes sense to focus on that. So if we look at live charts now, again, 1 second. I take a look at euro dollar now on the 4-hour chart. Or maybe even 1-hour chart. What we're looking for is basically to put a fib from here to here, right? It's only part of a 4-hour, actually the very last swing high swing low in the 4-hour chart. And on the hourly chart it would look like this. The very last, basically from the AO 0 point to the current AO 0 point, you can see it's a very strong 1-hour AO reading here, indicating a lot of momentum. So we can put a fib on that, and I would be looking most of all for the 38.2 fib, which is 120. It's also, of course, the broken psychological round level, and 120 with a stop loss at 120.57, I would say is okay. 55. Basically using the 50 fib. I mean, obviously the very technical correct stop loss is all the way here. That's another way of doing it. But if you want to, that's a very loose one. The target would be the minus 618 target here at 117. But you could even aim for 115 or even 113 in fact. Stop loss, as I said, if you're aiming for very far, you could use the loose stop loss. I will use a tighter one, as I said already, because I don't think that the price will be able to break above 50 fib. Most of the time, in a way forward, that doesn't happen. So I use the 50 fib as a stop loss guidance. There is some risk, of course, attached to that logically. But the tighter stop loss does allow for a bigger reward to risks, compensating hopefully enough of that extra risk though. So that's basically, I guess, analysis now translated into a real trading plan. So that analysis, of course, is twofold. It's basically based on candles and long-term analysis and the wave analysis. 21, it could go to 21. I think, though, that it will stop at 20, but that what could happen is when it stops at 20, it kind of pulls down and then starts moving up. So that's a good question, in fact, because that brings me to another point, is that if a trade does develop at 120, the price does go to 120, and I'm in the short, then I would be cautious of when price does this, and then down, and then here goes up, and then probably makes one more down, but then goes up like this. I will use this specific spot right in here, where I have the orange arrow, to trail stop the stop loss there. I think that's the critical point for trade development. So I think trail stops are pretty useful, but the only thing we have to be careful of is not to use them too quick, because then we're kind of like suffocating the trade. So, but if we use the, let's say, critical turning spots, decision spots, if we use those for trail stops, I think it makes sense, because then we've given space to the market, but then say, okay, this is our border. And it makes, I mean, if there's a real critical border, then it makes sense to use those in protecting the trade. But only the critical ones. So it's not easy to identify critical ones sometimes, but in this case, I hope you can see what I mean. If it hits the 38.2 fib, then moves down, right? Then it probably bounces. That blue, you see that blue spot there? It probably bounces because of the bottom here, right? So then you get a bounce. And you probably get a downside again because you will have one more respect for the resistance. So you get then the second red here down. Right? In that case, you want to, if you're in that trade on the short, you want to see price continue to the downside. If it doesn't, it could be correcting for a bigger upside. That's why where the orange circle is, or the pink dot, is a critical spot. You see what I mean? If you look at the path of least resistance, up to the 38.2 fib is possible, then down from the 38.2 is probable, then again up, then again down, but then I think is the key question, will it continue down? It should, and if it doesn't, then the shorts should be very cautious, I think. So that's the pink is where I would use the trail stop, and then be able to limit the risk if it does turn around and goes up to 121 indeed, like you think, like you're wondering if that's possible. I mean, if you look at the fib values themselves, 21 does not seem to be matching any of these fibs. It's either 121.25-ish here, 121.50, 120.75. Those would be levels more levels to think about, I guess, looking at the fibs. The euro dollar specifically, I think, not that I've tested it, but I mean in my experience, I think likes the quarter levels like 25 and 75. By the way, so I know that's a different story. So this is the euro dollar from all angles, I guess. Let's take a look at the pound dollar. Now the pound really is almost like an identical twin of the euro dollar in many ways. There are some very tiny differences, I would say. One of those is the fact that if you look at the monthly chart, 2014 candle is a bit different. We have a pretty half of a wick, we have half a body, and we have about 3.8% wick at the bottom. So it looks like this. Compare it to the euro dollar, and you'll see that this is basically the difference. There's a quarter wick instead of 50% wick at the top. There's no wick at the bottom, whereas the pound dollar has a 3.8. So even 3.8 is tremendously powerful. Anything lower than 5% wick is very strong. 5 to 10 is strong. But 0 to 5 is very strong, especially the euro dollar, which is 1/10 of a percent. Even 3.8, like the pound dollar, is strong, but of course less strong than the 0.1 of the euro dollar. That's the difference here between those. Still, though, euro dollar, pound dollar, very, very bearish candle last year, and the pound dollar has already fallen some close to 400 pips just this month alone. But basically, in the first 1 day or and a half of trading, it fell that much already. Logical target is the monthly bottom here at 148. When we look at the smaller time frames here, we can see basically the same formation as the euro dollar. Same kind of consolidation, first of all, and then also the drop. In that regard, it is the same, because if you look at this 4-hour chart, you will see an extensive, indeed, zone. It was perhaps slightly, I mean, the zone itself was perhaps a bit flatter here. Then it made a dip, but still stayed relatively flat. Then it made more and more smaller dips, so it started to get a bit of an angle like this, in fact, kind of, but all in all quite flat here, and then the drop. So in that regard, the pound dollar expecting to go to 148. Now, of course, if it breaks through that particular monthly support, by the way, you could even expect it to go lower, even to lower 140s. We'll have to see how far that dollar strength can bring it. Let's take a look at the wave analysis here. on the pound dollar. 4-hour chart. Let's see. We see here, for instance, that that entire sideways zone is a wave 4, right? With the same structure as the euro dollar, the WXY. So if we then zoom into the last part, this fall, which is for the moment, for us now, the most interesting, we can see the same probability formation. Small 1, 2, a quick 3, fast 3, big AO reading. So we can put a fib again from this top to this bottom, and we're looking at a wave 4 triangle that probably will turn into 38.2 fib. It's the same story, really. So the 38.2 fib is 53.40. 54.50 will be the 61.8 fib, which is possible, but it's a pretty deep one for wave 4. But there is a chance. I mean, I wouldn't know how much the chance is. I would estimate it as probably a quarter and 3/4 that it doesn't get that high myself. So let's take a look at the dollar yen. I'll stay here on the wave analysis for the moment. Dollar yen, here you see basically that big wave 3 here, and the 200 pip drop that happened here indicates the fact that this could be still getting a bit more correction. And that's why I already, when price is moving up, consider this probably to be next and expecting a downside for Y because of the bigger expected consolidation for wave 4. It seems to be working out decently indeed so far. So I'm expecting a bit more bearishness on the dollar yen to go to these targets here. Oh. The fib levels are at around 117 is the 61.8 fib. All right. So let's move over to the charts, and I'll show you that 200 pip fall on the dollar yen. All right. Basically, on a monthly chart, has brought the following consequence. The fact that we fell 200 pips created this wick at the top of 200 pips, right here. Right. Now it's not a substantial wick compared to the candle necessarily. Actually, the candle doesn't necessarily look like a reversal bar because I think the close was still too bullish. But it does look like a doji, and it does look like indecision. And the wick could show problems for the dollar yen to continue to the upside. All right. If you look at the fact that the euro dollar and pound dollar already broke the candle low, the dollar yen hasn't, that already confirms the fact that the dollar yen has a bit more problems with continuing to the upside. So if you look at the percentage that the wick is in relationship to the 2014 candle, the 200 pip wick at the top here is also of this month, December month, is also the wick that we have on top of 2014. That is about 9.5%, which is a lot more than the pound dollar 33.8. 9.5 is still pretty strong, but it's obviously not the very strong close that we saw in the euro dollar and pound dollar. So that's a bit of a difference. The dollar yen had to open here, the low was here, the high was here, and the close was 200 pips lower. So still a very bullish candle, don't get me wrong. But looking at the monthly wick, looking at the wave analysis, looking at relative to the euro and pound dollar, you can see that the dollar yen will I think still a very high chance it will break last year's high and continue up, but we'll probably have a bit more of a retracement before that happens. So when we look at the 4-hour chart here, we can see, I think that we'll see a bit more downside on this dollar yen. We could see perhaps price go up to down to 116.64, or which is the 78.6 fib, something like a contracting triangle like that, or even if we put the fib on this entire upside, even to the 38.2 fib at 113. Those are the main bouncing spots here. If we look at XAUUSD, it's a great example of indecision when looking at the yearly candle, because of the fact that when you look at the open of 2014, it is basically, one second folks, I don't know if you hear my cat, but I think she's complaining to me. 1 second. No, she's going away. Good. I wanted to close the doors here, but that's, you know, the cat's always interested in food. The open of this year is around here, 1240. The close is around 1220 actually. Where's the open? Now the open is 1204, excuse me. The close, 1183. So it's $20 candle. $20 candle, which is compared to the high and the low, a $300 candle. So first of all, $300 I think is a pretty small, relatively small candle, especially compared to the last year. Let's take a look at maybe a candle of 2007, for instance, to see how big that candle was. 640. $820. So it's not necessarily maybe a small candle in a historical sense. I mean, compared to 2013 it is, but the factor that it is a 300 some, let me check, $320, $315 candle, but the body is only $20, means that it's a doji. Anything I would say within 10% of the body of the candle is only 10% of the candle, excuse me. If it's 10% or lower, I consider it a doji. So anything that, and any body of the candle that's less than $30 is a doji, so that would qualify the XAUUSD with an open here and a close basically visually right at it, and a high here and a low here. So we have basically something like this. A bearish candle with a pretty big wick at the top and a very small body, something like that. Compared to last year's candle that was more like this. 2013, excuse me. So it's something like that. Which, I don't know, it looks more like indecision to me. Perhaps still a bit more bearish, because it did close bearish and did have some selling pressure because of the wick. So maybe we'll see some retracement and then again downside pressure. So last year's high was around 1392. So maybe we'll see a pop out of this triangle, but the pop could face serious resistance when it comes into face serious problems when it comes into this resistance. So shorts anywhere where we have the resistance line here. And we can put a fib. Let's see where we can put the fib on. Probably from here to here. Why? Because we had, it looks like we had a triangle here, A, B, C, D, E, fall. So if we put it from this to here, we already stopped at the 50 fib indeed. So anywhere in the 78 or 61.8. But the candle itself, as I said, it's not the best close for bears, at least. Not the strongest of close. Katie is saying maybe my cat is also interested in the webinar. Well, she gives good advices indeed. She shakes the head yes or no, or up or down, providing me extra guidance in case I can't make my decision. Let's see, what else? What are pairs we can look at? Pound CAD, for instance. I don't know if you have any particular pair in mind to look at. I mean, we don't have to look at the yearly stuff every single pair, but the pound CAD, for instance, when looking at the monthly candle here, you see that the open was about here, the close was about here, so there's a slight bullish candle, pretty big wick at the bottom, at the top though. I think it was about 40% wick. So really the close, I mean the bull's not in control here on the pound CAD. But it's still a bullish candle. So it's definitely, that yearly candle definitely explains the consolidation I guess we see here. Break of this zone is what we need. The yearly candle doesn't help too much in this case. It could actually go sideways and stay in this zone. Who knows? So I don't see any interesting setups, by the way. I just want to give you an example where the opposite is true, where really if you look at the monthly and yearly, that nothing really interesting is there to find. This is a perfect example of really nothing interesting. All right. Let's see. Odd USD. Let's take a look at that. Same bearish candle. It has a bit of a different, it has a bigger wick on top, bigger wick than even the odd, than the pound because of the upside pressure here, but same bearishness, exactly the same like all the dollar pairs in fact. So here too, expecting price to continue. There is maybe an 80, 79, 50 zone that if price breaks through that, we would expect more bearishness down to lower 70s. That's the long-term analysis here. And on the forward chart, was looking for the same things, basically for price to retrace to these fibs for downside, right? So what we're seeing now is perhaps that downside on the Aussie. If you didn't catch the 1 hour wicks here, then we can look at the 4 hour candle and wait for a bearish close. If it closes bearish, that would be a good signal as well. With the stop loss above this candle high, 15 pips above it, let's say, and an entry right there, I'll pound the candle close, or a small retracement of the candle, or the break of the low. There are three options basically. Market order at candle close, retracement of the candle, but halfway, or the break of the low, or any combination of that. It could be based on the 4 hour candle. It could have been based on the hourly, but that has already, in my opinion, has happened. I think that the short here or here made sense, but if someone didn't take that, then I think it's better to wait for the 4 hour in that case. Alrighty. Dollar CAD monthly chart is bullish. The close here just a few pips off the high. Let's take a look how much the difference is. The high 73, the close 19, which indicates 50 pips. The open right here at 106, that means about 1,000 pip candle, so it's about within 5%. The close is within 5% of the candle. So that indicates a pretty strong candle. No wick at the bottom, only kind of a pretty big bullish candle, at least for the dollar CAD. It's pretty big, normal size candle for the dollar CAD, I would say. And the close was very near the high. Something like this. Just a strong continuation candle. So I'm expecting that follow through to the upside. What can happen, of course, is you can always get 2 months up, some retracement, and then up again. It doesn't have to be one straight upside because last year was up. But ultimately, I think there will be some decent upside within 2015 looking at the dollar CAD as well here for the dollar. All pairs have dollar strength so far that I've seen. And let's see. It's actually, we can put the same fib here. Now, which pairs will have a deep retracement depends, I guess, on the relationships among themselves. We see that the Aussie retraced pretty deeply, but the euro hasn't yet because the euro odd is falling, for instance. So that will depend. Here we can see a bounce off the 38.2 fib. So we can wait here for the 4-hour candle too. I would say that's better because otherwise the bounce has already occurred, so it doesn't make sense to chase that now. It makes more sense to wait for the 4-hour candle to close and wait for about, I don't know, to put a fib on this smaller upside from here to here, wherever it closes, and enter at the 38.2 fib with a stop loss below this candle. Or below the 50 if that could be a bit more spacious. Let's take a look how the dollar CAD looks with Camarilla quickly. On an hourly chart, what I would specifically like, because everything is bullishly aligned, what I wouldn't be surprised if we're trying to get above the 21 band. You see that? So what I would specifically like is, often enough when it goes underneath the band and tries to escape it, it's kind of pulled into the band one more time. It doesn't have the power to, I mean, many times it doesn't have the power to punch out of the band in one straight go. I mean, sometimes it does, but many times you will see in this case kind of a hook back to the band. What I would like to see is that the next candle close above the band. Why? Because that's basically the strongest signal, I think. Let me, I'm not sure if it's clear, but let me explain it one more time, is that here we had a very strong power, just like on any dollars. Look at the AO. We're seeing here kind of a bull flag correction, where the bull flag correction brought price below the band. The best bull flag corrections are where price bounces off the flag, but here the bull flag didn't break. It just still made a bigger bull flag. So the bull flag corrected and the band changed gears here, went down. Now price is trying to get back above the band, which could be itself a good breakout trade right here, in fact. It's possible. There are multiple entries and multiple situations. One of them could have been the 38.2 fib, where I have the green dot. One could be here, where I have the blue dot as a breakout level. Another one could be to wait for the break and wait for the pullback and take it on the pullback instead at the red dot. Or the other one could be wait for the pullback, but then wait for the bounce as well and take it at the orange dot. I like the orange dot the most. So what you would see basically is price trying to escape here, the band, but it will hook back to the band and then use it again as support. That could be one entry. Or you could wait for a candle close that closes above the band. You'll see the band do something like this, waver sideways, but when it starts to break the second time above, it will start getting the angle to the upside, and you should see follow. I mean, most of the time there's a high probability of seeing follow through to the upside at that spot. That's the one I like the most. Does that make sense? That would basically be a way of using moving averages to get an entry on the hourly based on the larger time frame analysis that we are having. First of all, a very strong 2014 bullish year. Second of all, we have a very strong reading here, and we're basically a method to capitalize on the upside, that expected upside, without, I mean, in the case that you are not in this trade from the 38.2 fib, for instance. That's a backup. Not even backup, but as a different way. Sorry. I guess my point is that, as you can see, in my opinion, when using these tools, although even one particular trade idea has, let's say, has been lost. Let's say the it's true, the 38.2 fib price has bounced at that. So if you had that in mind and you didn't take it, that idea you can't execute that idea anymore. It's just, it isn't there, right? It's lost in a way. But just because one idea is lost doesn't mean that most of the time there are quite many still methods to join a trade at different spots, at different areas that are maybe even better or not much worse in any case. Surely there are some cases where indeed you missed a trade and the trade just flew away, no more possibilities to join, right? I don't think there are many though. We can take a look at the odd CAD indeed. Let me quickly look at the euro odd, by the way, here. I wanted to tell you the euro odd. I had it on my list to show you the euro odd because of the fact that last year was, I thought, an interesting candle. It was, let me retract here, was an open all the way up here. So a very small wick on the yearly. Pretty substantial downside, and the close was all the way up here. So it was a pretty big wick at the bottom. So it was something like small wick at the top, candle close something like this, and then a wick like that. That was 2014 euro odd. After a 2013 candle that was pretty bullish, in fact, something like this, I would say. So it does have reversal potential, I would say, because despite the fact that there is a wick here at the bottom, I think there are two things that are important. First of all is that the candle, it's still a bearish, pretty decent bearish body. It's not like an inside candle, like, for instance, a bullish candle followed by something like this, for instance, which has more bullish implications. It's more like an inside candle that could see follow through to the upside. This, in fact, is more like, has a decent bearish body. So I would say it is more, in that regard, more bearish. Also, if you look at the monthly chart, you see a pretty big wick on December. So it looks more like a hook back. It looks like a fall retracement hook back to me. So last month's low would be important. The euro odd has already traveled down a lot. I was looking for retracement already here upon the break of this line. Then here as a follow through, that has happened indeed. Not that the last one was tradable because it was already Christmas at the time, but let's see. So now, basically looking for a follow to the downside. I have to take a look. 1 second here. This could be still a supply-demand zone here, so we could see some bounce perhaps. I mean, preferably we break this zone. It's just that I don't see any trade setup, to be honest, right at the moment. I'm looking and looking. I don't see it at the moment. I think long-term it looks bearish, though. But I don't see a trade setup short that would make sense now, though. Let's take a look at AuCAD. There we are. Alrighty, AuCAD. Okay, open here and close pretty much the same spot. So it's a doji, but it's a doji with a little big wick at the top and almost no wick at the bottom. So it's something like this. So I would say pretty substantial bearish pressure, and definitely looks more bearish. So it looks more like CAD strength here, in fact. Aussie weakness, looking at the yearly candle at least. Doesn't match up much with the euro odd, I guess, but that's what this pair is saying. But of course, it's not 100% science. But so yes, looks more bearish, in fact. Of course, we could see some retracement of the last year's wick, because it's a pretty big wick, as we said. So we could see some retracement up to retrace part of that. It looks like we're doing that right now. If you put a trend line like that, it looks like we're trying to retrace. So at the moment, it looks more like a buy than a sell, but because of that break, maybe not a buy right now, but because we're right at the top of this channel. But if we get back to the bottom, it looks more like a buying zone, despite the fact that maybe this year will become bearish. So that's the AuCAD. Let's see. Happy New Year to you too, Ilya. I actually totally should have said it myself. Happy New Year to everyone. It's already it seems so long ago, a few days ago, so I didn't think about it anymore. Hope that everyone will have a great, successful, profitable 2015 and healthy. Let's see, Kiwi dollar. Let's take a look. Does anyone else have a particular pair in mind? There we go. Kiwi dollar. Let's see. We had an open, probably the same as the Aussie. Yeah. We had an open here, big wick on top, but a bearish close. Not a very substantial body, but a pretty big wick though. So the yearly candle definitely looks bearish. I mean, couldn't be any doubt about that. There's been some consolidation here recently, as we know. Big consolidation. yucky, pretty spiky. Let's see, a sell at 77.70. Looks to make sense to me. Let's put a fib from here to here. That would be a 4-hour fib. 77.83 here. On the hourly chart, could use the same fib. 77.80 indeed. Yeah, 77.80. Okay. Yeah, I think that makes sense. It looks like I mean the only thing is that the whole pattern looks pretty zigzaggy. Looks pretty choppy, sorry. Which I'm not a particular fan of. But indeed, anytime we've moved up, we've seen some downside. So this could easily happen too, indeed. If you look at the pattern, though, I would be careful with the TP probably. Not aim too far down. Maybe aim just pretty conventionally for a smaller profit about halfway this upside. Aiming for this this blue line here. Let's see, 77.70 indeed. 77.75 is a monthly and daily R2. So anywhere indeed 77.70 to 77.80. Yeah. Seems some extra resistance there, some extra confluence, and H5 as well there. Another good idea probably could be to, instead of looking for a market or that pending order there, would be indeed to wait for, another approach would be to wait for price to get there and wait for a turnaround signal. Alrighty. Thinking which other pairs could make sense. Let's see. Let me think for a second. Maybe the pound odd. Let me think for a second. Pound yen. Your cat. Okay. Take a look at your cat. There it is. EuroCAD. We had an open up in here, 146. Close at 140. So we had a pretty substantial wick, about 900, about 67% wick, and a pretty bearish close near the low. So it was about 67% wick, 33% body, bearish body here of the candle. So yeah, bearish, definitely bearish. A whole different ball game, of course, when compared to the dollar cat. More similar to the odd cat, if anything, but more bearish, I would say, even because it's a bearish bearish candle, still not a doji in a way. So absolutely bearish. Absolutely bearish. Last month was also a pretty big bearish candle. From a bigger perspective, it's not easy to see a trade right here because of the fact that price is pretty close to this bottom. That doesn't make it easy. Probably have to zoom into maybe a different template here. I don't see an interesting setup as yet, but obviously if it retraces a bit higher, it gets more interesting to short. So how far would it have to retrace? The weekly pivot point, for instance, or even the monthly pivot point up in here, let me put a line there, would probably be needed to get some more decent entry potential there. Now, if it doesn't get that deep, the alternative would be to take a breakout trade. What you can use is the moving averages on the hourly here, wait for a double dip. Let's see, something like where price is substantially above the band like it was here. If it does that again and then closes below it, that could be still a good breakout trade. In that case, I would assign the probability of price getting up to that high as less likely. At the moment, I'm still cautious of retracement because of the bigger monthly support here. But if it does something like this and then moves down, I think that chance is lower. Is low enough. Now it's not low enough. So I'm still more in a wait and see. It's definitely bearish in the long term, but I'm a bit cautious with taking a trade at the moment. All right, so thanks for joining us. We have a webinar tomorrow with strategy, and then is going to take a look at Bollinger Bands, squeezing the railway strategy Wednesday evening, and to Thursday evening we are taking a look at understanding and surviving drawdown. I think there will be a lot of practical tips that are useful and beneficial for you. So I hope to see you in this webinar especially, but also in the other ones, of course. Once again, tomorrow, strategy in the morning, then Wednesday evening, tomorrow evening, and then with Bollinger Bands and his strategy. And then Thursday evening, we're going to take a look at drawdown. I really want to encourage the drawdown webinar, especially because I think it's actually, everything is important, of course, but if you don't handle this, it will block success. Let me say it this way. Other things are important, but I don't know, still you could, in a way, maybe manage to a certain degree with an okay approach. Here, I think there is no middle ground. I think it's either you know about it and you understand it, you can handle it, or it eventually leads to capitulation in a way, or it leads to problems, big problems. So I think that this one is something that, I mean, it must be rock solid. You have to have a very good understanding of what to expect and how to handle it, I think. So I think it's very important for the long term. So I would definitely recommend this one. All right. So thanks for joining. I hope you enjoyed this long-term analysis. I always think it's interesting to look at yearly candles. I think they give good information. So we looked at some of them. There are a lot more left, but I'll leave that up to you. Tomorrow we'll look at strategy. We won't dive into this long-term stuff anymore. And once again, wish you, well, a fantastic 2015. I hope you'll join many of our webinars this year as well. And wish you good trading in the meantime. See y'all soon.